Good afternoon.
Good afternoon.
How is everybody?
A-OK in Chicago.
Hang on.
Good to see you again, Manuel. Just like I haven't talked to you for 8 hours or so.
Right?
Yeah.
They're doing good. We're waiting for that rain that you call for, Mike.
It's here. It's just coming through here. So hopefully it gets over to you guys if you need it.
Getting cloudy here.
Yeah, I want it to clear out by tomorrow. We're playing Michigan in football tomorrow. I'd like to have a nice day.
There you go.
Yep.
All right.
Right. So for those who don't know, Kerry is on vacation and he will be back next week, hopefully with his luggage.
Yeah.
If you haven't heard, Southwest Airlines decided to send his luggage and my mom's to Chicago. So up there, if you'll look for it, Manuel, I'd appreciate it.
Manuel could probably go pick it up for him.
I can probably pick it up if you said it.
Yeah.
So,
he'll show up next week in Kerry's shirt.
yeah, right. So needless to say, I'm curious to see if they get their luggage back at all. But so Mark and I are gonna host the show today, and Mark's gonna lead off with a look at the economy versus the stock market, and then a popular ask that has been come up a couple times this last couple weeks is NBIS versus CoreWeave. And so I did a comparison video and put it on the Discord. I'll put a link to it as well down here. But I wanted to discuss the differences between these two companies and open it up to the floor for some discussion about the two different approaches, the companies, and what your thoughts about it from an investment standpoint. So, Mark, I'll turn it over to you.
Okay. I want to go over some thoughts I have, and I got some notes just to keep me on track, but try to keep it short. But I've been thinking a lot about the current economic situation we see ourselves in the United States today, and consider what I see. I'm trying to understand why the markets are at all-time highs. So I had to dust off my economics degree and reacquaint myself with the fact that markets are not the economy. We say this a lot, Trent and I, and a lot of people do. And the economy is not the markets. We have a profound contradiction that defines our current financial movement. On one hand, you have headlines: the U.S. stock market is at all new-time highs, with the S&P and NASDAQ reaching record valuations. And then on the other hand, we have the news, the economic reports, and even your own daily lives telling a different story. We're seeing clear signs of a slowing economy, from weakening consumer confidence to rising corporate bankruptcies. So this leaves us with a central question: if the markets are not being driven totally by the economy, then what forces are propelling it to those record-setting heights? So as a student of technical analysis, let's take a look at the hard data and analyze what might be causing the disconnect from the market and the underlying economy. So you guys feel free to jump in at any time, but I'm going to go through kind of my thoughts here. So I'm going to say the quiet part out loud, economically speaking, and I want to pull back the curtain on the economy we're living in, and not the economy that we get told by, Fox Business or CNBC or Bloomberg. The traditional indicators are just not slowing, in my opinion. In many cases, they're contracting. So first, I want to bring up the labor market. For months, we were told the jobs market was a source of strength, but the narrative has really changed lately. The U.S. economy just added only 22,000 jobs in August, well below the consensus forecast of 75,000. And the unemployment rate rose to 4.3%, and that's the highest it's been since late 2021. Even more troubling is the Bureau of Labor Statistics recently just announced a major revision to their numbers, wiping out just under 1 million jobs from earlier this year. And this means the economy was adding far fewer jobs than we previously believed. They were stating 150 to 160,000, when in truth, we were only adding maybe 50,000. So to me, it's a clear signal that our labor market is losing its footing. And I always said that was kind of the third stool. The third step on the stool was if labor and people started losing their jobs, Then we're going to see the housing market. Then we're going to see the consumer spending and all that start to slow because people are worried about spending more than they have. So next, I want to look at the strain that each American has. And on average, I'm not sure that a lot of what we see on TV represents what's actually happening out there in the United States. The financial strain on an average American, a recent PNC Bank survey found that 67% of U.S. workers are now living paycheck to paycheck. And a year ago, it was 63%. So it's gone up 4 points. The report from VantaScore shows that the delinquency rate for consumer loans, things like credit cards and auto loans, have increased by 60% for middle income households since 2023. And these are the people that would most likely be living paycheck to paycheck. So we're seeing people are feeling the pinch and they're starting to fall behind on payments. We talk about this. We've been talking about this for a year. We show the numbers. They don't quite jive with what the government tells us, but we can see it and we can feel it. And it's not just individuals. The number of bankruptcy filings for large and mid-sized companies has hit the highest level in over a decade. And in fact, this morning on the Morning Edge, we talked about the subprime auto loan company Tricolor filing bankruptcy, and they have over 25,000 creditors, and that this could set a ripple through the credit market, similar to what we saw on a smaller scale when the housing market fell in 2008. So as of July 2025, total filings are 446 bankruptcies so far, and that's a number we haven't seen in this 7-month period since the aftermath of the 2008 financial crisis. So what's driving this? And I think the answer lies in a disconnect between capital and fundamentals. On one side, you have capital flow disconnect. And what this means is the report from major financial institutions indicate that professional investors and corporate insiders have been consistent net sellers of equities this year. They're taking profits and they're moving to the sidelines, moving to safe havens, seeing a market that's overvalued and full of risk. And in the contrast, retail investors, such as who we are, we've been aggressive net buyers, pouring in a record amount of capital into the market. And this divergence, when you look back in history, is usually an often classic late-stage market signal. On the other side, you have the liquidity and debt disconnect. For years, the Federal Reserve's easy money policies, including ultra-low interest rates and quantitative easing, pumped trillions of dollars into the financial system. This immense pool of liquidity, we always talk about liquidity, had to go somewhere, and a large portion of it found its home in the stock market. At the same time, corporations were able to borrow money at historically lower rates, which they used not for new factories and expansion, but to buy back their own stocks. This creates a powerful artificial demand that was a direct result of government and central bank policy. So I think to myself, what's really moving the stock market? I just went through just a really small list of things that I see that are looking like and bring back memories of the great financial crisis and .com bust. So first is the market is not powered totally by fundamentals, in my opinion. It's powered by two massive mechanical engines that operate on autopilot: the corporate stock buyback program and passive investing through 401ks. First, the corporate stock buyback programs. Buybacks when a company uses its cash to buy its own shares, which reduces the total number of shares available. This is crucial because it mechanically increases the earnings per share, the EPS, even if the company's net income remains unchanged. A higher earnings per share, or EPS, at all else being equal, means a higher stock price. So to illustrate this, if a company has $100 million in earnings and 10 million shares outstanding, and then they buy back, and its EPS is $10, okay? But if it buys back 2 million shares, okay, now there's only 8 million shares outstanding, the EPS instantly jumps to $12.50, makes that stock appear more valuable. So the modern era of buybacks began with SEC Rule 10b-18 and in 1982, which gave companies a safe harbor from market manipulation charges. Prior to this, they couldn't buy their stocks back because it was thought there'd be market manipulation. And in a way, you see how it affects their stock price. It kind of is. So it makes it a safe and popular practice. In fact, Fortune S&P 500 companies have since repurchased nearly 1 trillion in shares over the last 12 months. This consistent, enormous demand for their own shares acts as a constant upward pressure, providing a financial floor for the market. The second, the unstoppable rise of passive investing through the 401k plans. Passive funds now control more than half of all assets in U.S. equity funds. The root of this trend is directly tied to tax policy. The Individual Retirement Account Act was created in 1974, and the 401k followed in 1978. So both these programs, buybacks and passive invested through a 401k, started really in the early 80s. When a passive fund receives new money from an investor, like when your paycheck every 2 weeks, okay, it normally goes in and its managers are obligated to buy the stocks in the underlying index according to their market weighting. Okay, and we talked about market weighting in the S&P, that it's dominated, the top 10 stocks is 37, 38% of the market weight. In the Qs, it's almost 50%. So every time that money goes in, you're buying blindly that amount of stocks, or the market, or the managers are. So this creates a relentless cycle. As money flows into the passive fund, it buys stocks, which pushes their price higher, which increases the fund's value, which attracts more money, which pushes the prices even higher. This effect is particularly pronounced at the current market, where the AI revolution has been the fundamental narrative. The vast majority of new capital in passive funds has flown into a handful of mega cap technology stocks like NVIDIA and the Mag 7s, creating a concentrated rally. These companies' stock price have soared, which has increased their weighting in the index, which in turn forces passive funds to buy even more, creating a self-fulfilling prophecy. Excuse me, my allergies are kicking in. Oh man, when you put vodka in one of these bottles, it tastes pretty good. So there's really,
It is Friday.
yeah, it was not time yet. There's an additional ticking time bomb on top of this that we've seen in history, and that is margin. This market is not only being driven by these mechanical forces, but also fueled by all-time high, or fueled by historically significant amount of leverage. Margin debt has reached a new all-time high, approaching over $1.023 trillion. And this is a powerful vulnerability. Sudden decline of just 15 to 20% from a market peak could trigger a massive wave of forced selling. And I saw this in the .com. I saw this also in the great financial crisis. I would go down to my margin room and watch them sell people out. Okay, forced selling, it causes a cascade effect. It would turn a simple correction to a major crash. And this is the very dynamic we saw in the .com bubble and the great financial crisis. Like I said, I go down to the margin areas, listen in to calls. And when you have margin, they can take your house. Okay, they can take everything you own because you've signed that margin agreement. And a lot of people don't know that that's true. So be careful on margin. I don't use margin personally myself for trading, but back in those days when markets get very frothy, people think that it never goes down. They get out leverage on margin and it can really destroy you. So just be careful. So I looked at, if we didn't have these two programs, the buybacks and the passive investing, what exactly would the market look like today? I think it'd be in a very different place. The massive and consistent demand would disappear. Okay, you have demand every week on passive. You have demand every year, every quarter when they buy back their stocks. And the market would have to rely really on fundamentals and active investors are already selling. So a reasonable estimate is that without this artificial support, the market could be 15 to 30% lower than its current levels right now. Current valuation of the markets is simply not supported by the underlying economic reality. Markets are way overvalued, okay? When you look at the S&P trailing 12 months, we're double where it should be. We're in the 30s. Look at the Shillers, it's the same thing, okay? And that's about the same time we saw the .com and the great financial crisis. We saw the market turn when it got that high. So to sum it up, the markets is not the economy. And while approximately 62% of the US population owns stocks, the distribution of that wealth is highly concentrated. The wealthiest 10% of US households own roughly 88% of the country's stock market value. So the question for all of us is not what's driving the market today, but rather how long can these two engines run before the economic reality we've discussed reasserts itself. So that's my rip for today. Any comments, any thoughts on that? That's just my thoughts of what I'm seeing.
Mark, I would, more and more you get into looking beyond just charts or the news headlines, the more and more you see what really is happening under the surface. And what you're talking about, I think is, it's a reminder of my time, my entry into the financial advisory world was during the dot-com boom bust. And today, when you have that time in that history in seeing how this stuff works, you start to see similarities, and you see this excitement concentration into one sector or one subject matter. And right now, back in the late 90s, early 2000s, it was all about the internet boom. It was about companies coming online. They started in their mom's and dad's garage, and now they're billion-dollar companies and they don't make any money. They're littered with debt, but that doesn't matter anymore. And I remember Joe Kernan saying something to this effect, that it doesn't matter if you don't make any money. You're a .com. If you had .com behind your name, people were buying you. And then it all stopped. And the one common thing that you look at that, you look at the great financial crisis, you look at the commonality, and there's one specific thing, and that typically is debt to cash ratios in a company. How much debt are they carrying? What's it costing to service that debt? And can they survive a slowdown or downturn in their revenue? And I think that's where, in my opinion, we're seeing that happen. We've seen the ramp up in AI. It's literally done this since November of 22, and now we're doing this. And we show it in the charts on the Morning Edge every morning. They're all like flatlining and hitting these ceilings. And I think it's something you got to pay attention to in a big way, because if you look at the leverage ratio between now and 2010 or 2007 to 9, we're like 10 times more leveraged. There's that much more capital out there. And I think this sort of, in my opinion, this is one of those yellow flags that you got to be paying attention to. And I think if there's anybody else wants to jump in on here before I hit upon
And
this.
I'm not saying the market's done going up. I mean, we had a quarter of a basis rate cut, and even Powell himself said it wasn't going to make a difference, quarter of a point. And you see
Yeah.
the small caps going up because now they can win. So it's quarter of a point. Okay. I don't think that's going to save a lot of, the companies out there that are relying on financing to run their operations at this point. So again, markets are not the economy, but I just want to bring that out because my sole purpose for being on this and helping Trent and Kerry is to avoid the voices that I heard on those phones during the great financial crisis, during the dot-com when I was in the business, of people losing their homes, losing their cars, losing everything, losing all their stocks because you don't have an opportunity. They sell you out right there. Whatever you have in the account is sold out. And I was also looking at, this morning when we were talking about tricolor, banks are out going to used car lots for these cars that got bought and trying to secure them before they get sold or moved off somewhere else. I mean, it's serious business. We're not there yet, but a lot of the stuff that I talk about, and Trent just talk about leverage and talk about paycheck to paycheck. We talk about delinquencies in credit cards, auto loans, student loans. We look at the housing market slowing down. You just got to keep that in the back of your mind. It doesn't mean you can't trade, doesn't mean you can't be in the market, but just be ready and, have a plan if something's going wrong, know when to get out and don't follow it all the way down, because if you would have went down what was Trent in the great financial crisis, what did it take you 15 years to get back to even, something to that resort?
Yeah, I mean, what during I remember the whole
For 10 years.
10 years. Now, there you
yeah,
go.
it was if you held the S&P, I think it took you about 5. If you sold out and then tried to jump back in, most people jump back in where they on the biggest part of the move, and it took a long time.
10
I
years.
remember I remember talking to mutual fund representatives, and what was it, 2017, 18, and them saying, we've got financial advisors who still haven't put money back to work for their clients.
Yep.
And I'm like, that's like 8 years ago, 9 years ago. And they're like, yeah, and they're panicking and their business is falling apart. And I think it though, when you have a process that can really help you manage a lot of what we're talking about here. Vijay, I think
Yeah,
I saw your
uh,
hand to go up.
yeah, I have a couple of questions. One is the Mark discussion about this two. One is the buybacks, and another one is this 401 passive investment. My understanding was this buybacks indicates that specific company is confident about their company, so that's why they're pouring money into that one. I thought that would be a positive thing for that stock or for that company stock. What's your take on that one?
Well, I think it's a positive thing for a shareholder because your valuation goes up, so you're not competing against all those shares anymore. But what it does to people who evaluate companies and the market in general, their market caps, is it causes the share price or the earnings per share to go up because you have less shares. So it messes with your financial data, okay, without really increasing any of your revenue whatsoever. So you need to be careful evaluating companies who do that. And again, I am under the belief that if you're a company and you have that much money and you have nothing to do but buy your shares back, you're not out using it for capital expenditure or buying something else or doing that you really have no imagination on what to do. Myself, from what I grew up knowing about companies and what we used to do.
So do
But
you think
as a shareholder, it helps you out because it makes your stock more valuable.
yeah, do you think in long term, I mean, is it a beneficial long term basis? The buyback?
Honestly, I think the one thing Mark hit on was, if I have a ton of cash as a corporation and I decide to go buy back my stock, what was the decision to say is that I just don't have anything to build out or buy, to buy another company to acquire, or do I not have
The CapEx.
R&D to put to work? Am I not thinking creatively as a company that, that's a big thing that's happening right now, is capital is being, like, in this whole AI, kind of landscape. What are a lot of these companies doing? They're borrowing money to build out their businesses even further. At what point does it all of a sudden you can't build it out anymore? At what point
Yeah.
does the leadership, like, not have a creative, idea of what they can do next? And I think we talked about this, I think, a couple or earlier this morning about Apple. I don't know if they're on a buyback spree, but their product line is it's just the same thing, and they're not evolving. And I think when you see that happen, they go, okay, well, what do I do with all these billions? Well, I'll just start buying my stock back, which shrinks the supply. And as you dump money into your 401k plan, it goes and buys Apple within that large cap growth mutual fund. Well, it just continues to drive the price up. So they're basically shrinking the supply of stock available for, in this case, let's say hypothetically, say Apple or any company who does that. To me, that's, you buy companies for innovation. Kerry's watch list and tell sheet is full of companies who are spending money on innovation and
Yes,
trying
sir.
to grab market share through new products.
And my second question is about, I think, the current, I think, the market looks like dot-com bubble. So what alternatives we have to safeguard ourselves?
I think you compare today versus the dot-com bubble, there's a handful of major differences. And one of that is the derivatives market. The derivatives market in the dot-com era, that would be options and future contracts, was very small in comparison to where it is today. And I believe, my opinion only, that the derivatives market is really, in a way, suppressing volatility. And I talk about it in the mornings on the morning edge a lot. But I believe as since the introduction to 0 days to expiration options, we have seen a suppression of volatility in the market until we don't see suppression of volatility. And so, what is the protection of a major downfall? If we saw a major bank like a Bear Stearns in '07 who went upside down were to happen today, yes, you could see a major drawdown in the market, but the rebound in it, I think, would be pretty quick. Um, and that's where I think the leveraged element, the derivatives market, has really made a major impact on how markets trade today. And I mean, I got a email was discussing some with a subscriber, and he's like, I don't buy stock anymore. I buy long leaps. I buy long-term options, which means he's getting the leverage, but he can take less risk. He's making more money, but he's risking less money overall. And so all of a sudden, go back to 2000 or 98, 99, 2000, and it's a whole we didn't have that. I mean, we didn't have access to that, use that. Today, that's a bigger part. So I don't know. It's a double-edged sword. I think if we do see a pullback, it will be quick, it will be credit related, and it will rebound quickly because just like we saw back in during the Liberation Day back in March, April, you know, we recovered that really rapidly. So I guess it's more of having a risk management process and knowing what you can't, what you can lose and how long you can lose it for really comes into play. If you're 55 or 56 like myself, yeah, I got a little more time ahead of me. But if I'm 71, taking risk in an environment like today is, in my case, in my opinion, very dangerous. So you have to really evaluate your risk exposure, especially when every morning Mark points out the S&P is back up at that green line of death. It keeps hitting. So,
Sorry, may I say something?
yeah, please.
I don't have
Good
a
to see you,
facility.
Patrick.
I don't
Hey,
have.
Patrick, where have you been?
I've been around. I haven't been very well lately, but
Oh no, that's too bad. I hope you're better.
yeah. I don't have the facility for putting my hand up. It's not available on my screen. But anyway, I just want to bring up the Elliott wave theory about what's going to unfold over the next couple of months. And I asked ChatGPT whether any analysts on the Elliott wave analysis that correctly predicted the April dip, and there was only two, namely Action Forex and E-Wave. So I went in and I asked ChatGPT what both of them were predicting over the next couple of months, and they came up with this scenario that early October it would reach 6,800, and then by the 5th to the 8th of November it would dip to 6,420. That's a fall of 5.6%, and then it would then rise to January the 2nd to 7,600. That's an 18.4% rise.
I believe we'll see 7,000 on the S&P in the fourth quarter. 7,600, I don't know. I mean, that's pretty gigantic move, right? But from where we are now, or this morning before market open, I think it's about a 5%, 6% move to 7,000. which would
yeah,
be a
another
nice
thing I
return.
found. Sorry.
No, go ahead.
I also noticed another thing: the top 22 of Kerry's bus. I found that the beta metric was 1.7, and that's a good indicator of how that basket of stocks will react in the S&P 500.
Gotcha.
I guess you know, we all look at all indicators and everything. I can't predict what's going to happen up or down. I can't. And
Yeah.
I can't guess, you know, if it's 7,000 or 76 or 8,000. And all I know is, you know, I just saw, you know, Jay Raymond, he says the important thing is to have a plan for protecting your positions. For me, I've stopped, set, and adjust on at least a weekly basis. So there's his plan,
Yeah.
you know, and you got to be careful on the downside. And again, you got to determine what position you have as a trade or an investment, because you'll think about those two differently.
Yeah.
And by the way, I did see that Apple buyback program is the largest in corporate history. The company has repurchased over 680 billion in shares since it began the program in 2012. Those
Wow.
buybacks are a primary reason for the company's sustained stock price growth and are a key factor in its market valuation. So they've used it actually to keep their stock price rolling too, in my
Yeah.
opinion.
I mean, if it rebounds back quickly, I mean, then I mean, keeping in the market is not a bad idea, right? Like as I think Patrick indicated, based on the Chat GPT,
Well,
the S&P 500.
Vijay,
But
Vijay,
I wouldn't
I,
put your shirt. I wouldn't put your shirt on it though. That's the only thing.
Vijay, I would say you've been around long enough to know one way you think sometimes can come back and hit you in the face.
Yeah,
You know, you just don't know. And that's the problem. I saw an interview with Lloyd Blankfein, the old CEO for Goldman,
yeah.
and he says, yeah, something's going to happen. He said, well, I just don't know what's going to happen and what's
Yeah.
going to trigger it. And I
That's
think
me.
that's where, you know, you can be in a fearful position, but you also, and that could sustain, you know, stop you from your portfolio growing. That could put you on the sidelines, that kind of thing. Or you could take an approach of what are the little variables that affect markets and affects the companies I own that I need to be aware of, and how do I protect myself from them losing 5, 10, 20, 30%?
Yeah.
But
So
yeah,
I wanted to, because we're talking about this, and I think Omar, you brought Nibius into the conversation a couple weeks ago, I think.
yes,
Was
I
that
said
you?
it looks better than CoreWeave, but I was
Well, I
waiting
want to
for the
get,
analyze that what you did, and then it went up 50%, but I stayed with it.
yeah. So I want to hit upon this um, because you had brought it up and it had come up, I think for the last 2 or 3 weeks on Kerry's Zoom call here. And so I went out and I went to ChatGPT and I went and gave it all these metrics in this fractal model that I use. And I said, compare these two companies. And so I wanted to hit upon that today. And I think in the light of the conversation that we've just had, and Mark is pointing out about leverage and about risk, these two companies are very interesting from the perspective of how they're approaching the GPU cloud computing market at this point. As some of you know, if you've done some research, Nibius is based out of Amsterdam. The company used to be called Yakun, if I can pronounce that right. They're both in providing GPU powered cloud services for AI workloads. CoreWeave's out in New Jersey, up there near where Bob is, and both of them don't make any money. So that's your first start. Neither one of them are making money, and the biggest reason they're not making money is because they're spending money. They're building out their services. They're building out their overall what product line that they're offering. But when I got to digging into this, what I found was they're similar in what they're providing, but they're going about two different markets. first of all, Nibius is focused on the small and mid-sized enterprise AI lab type companies, versus CoreWeave is focused on the hyperscalers. They recently did a deal, I think it was second quarter of second quarter of this year with with OpenAI, and overall they did a deal that is collectively worth $15 billion with OpenAI. This is CoreWeave, so they're going after that mega company. I did some more digging and I found that 71% of CoreWeave's revenue is coming from Microsoft. Okay, so their CoreWeave is very concentrated into the big hyperscalers, multi-billion-dollar contracts, this kind of thing. You look at Nibius, and they're probably, when it comes to size and where they're in their scaling process, they're behind CoreWeave in that sense. But their market is more small and mid-sized companies, and a lot of them. So they're diversifying out their client base, versus CoreWeave is very concentrated into a handful of corporations. Now, the first yellow flag I see, or red flag I see in that is, what happens if Microsoft scales back their services? What happens if they say, you know what, we're not getting the demand that we anticipated, we're scaling back our services, and CoreWeave, sorry, but they start to see a decline in revenue. How does that affect them? Well, it's going to affect them. It's the same way it would affect Nibius, but Nibius is a little more broader, small and mid-sized companies, bigger portfolio of business. Bear with me here.
And
Nibius
looks
right
like
now, what's that?
it looks like Nebius, like they have more deep capabilities of like software and hardware and like onboarding of clients, what I checked.
Correct. That's what I'm seeing. Here's the biggest thing in light of what Mark pointed out. Right now, Nibius sits on hold on one second, sort of jumping around in my notes here. 2.4 billion in cash. Part of that was an equity investment from a large investor. They have very little debt, versus CoreWeave, which has where is it? Come on. Sorry, I'm jumping around my notes here. CoreWeave has 1.3 billion in cash, but has 8 to 9 billion in debt, which in second quarter cost them $267 million to service. So if you look at the cash to debt ratio between Nibius and CoreWeave, there is a drastic difference. And when I look, just since the conversation we started with Mark and about debt and about leverage and this, that, and the other, the concern I have here is that CoreWeave is very vulnerable. If you're servicing $267 million in debt a quarter versus a company that isn't, if you have a blip, if you have an interruption in revenue, this is when things snowball. And we saw this during the dot-com boom bust. We've seen that during the great financial crisis. So that is one thing that I would say I'd be concerned about CoreWeave.
Yeah, I have the same concern, but I have the same concern. So I was able to get to someone from NVIDIA, and like what I understand from the guy from NVIDIA, two things. First, I saw that like NVIDIA said, whatever, like if somebody is not taking all the supply, we will take it. Like they kind of guarantee CoreWeave that NVIDIA themselves take all the supply. And because NVIDIA have a big chunk in CoreWeave, it looks like the NVIDIA strategy, it looks like, you have to check it, but they tried it like, because you have a lot of players like Iran and other like Iran, So it's look like they are trying this CoreWeave. They will be the model that's everything like that's basically NVIDIA will do everything for CoreWeave. They're more like financial player. NVIDIA is doing everything, also like the chips, also the switch. Like they get like it's ready, and if it's work for CoreWeave, they can like do the same for the Iran players, like
So they
other
can
players.
switch out their product delivery. There's enough people
Exactly.
for demand.
Exactly, and they said that we will buy everything that's like nobody is buying from CoreWeave. So it's make me more comfortable, but it still looks like Nebius controlling their future, and CoreWeave is depends on like on NVIDIA strategy or like I don't know, like they left
So
by their own.
what if I remember right, if my notes are right, NVIDIA made an investment in Nibius.
That's correct.
Yes, but I
Correct.
think in
Okay.
CoreWeave they have more.
CoreWeave, they have more investment in them.
You have to check it, but that's what you have to.
Okay. Okay. I guess what I look at this, it's like the question will come up, how do you allocate to this? Do you invest in CoreWeave or do you invest in Nibius? I think at this point, from my opinion perspective, Nibius is a small, mid-sized market. There are more small and mid-sized businesses in the world versus hyperscalers, large businesses. NVIDIA's play within both of these companies, it's a matter of supply. They're going to supply whoever demands their product. And so when I look at this, I go, okay, well, these two companies have value. There's value to be had here. When it comes to risks though, in the environment we're in, I look at Nibius as the company that could survive some level of major slowdown in AI expansion or data or GPU growth expansion. Because one, they have cash. Their debt is low versus CoreWeave, their debt is high and they have low cash. They can't pay their debt off at the end of the day. And so when this environment where we're at, Nibius is more of that one I would allocate more to, consider allocating more to, and less to CoreWeave. But I do believe they do both have different footprints, somewhat overlap, but not much. They both have different footprints. And that's the other thing to take into account is the markets that they're going after. CoreWeave is major players, Microsoft, IBM, OpenAI. Nibius, probably haven't heard about a lot of the companies, but
Yeah,
those
but
companies
also
need
for,
their services
for
as well.
government. Nebius is
Huh?
also working with governments, with like
Okay.
the English government. They built like their supercomputer. Also in Israel, they build a supercomputer. So it's
Mhm.
like also B2C, also B2 government, which is another nice play.
Yeah. If you look at the charts on each one of them, if we're looking at it from a chart perspective, I'll put this up here. Can you all see that? This is Nibius over here. Same time frame because CoreWeave's just a new IPO. And so they're going through their initial phases of people who have invested in them before, private equity, that kind of employee compensation programs have not all like filtered out. So I believe in December, CoreWeave will have employees of CoreWeave will be able to sell their positions if they want to. So we could see once we filter through that phase of being publicly traded, then I think you're going to get a better view of where CoreWeave is headed. But if you look at Nibius over here, it's just consistently going up. Now, there's this major gap that happened back on September 8th to September 9th.
The
And
Microsoft deal.
typically, what's that?
It's the Microsoft deal. Microsoft bought from them 17 billion of. It's a huge deal.
Yeah, it's
Microsoft?
71% of their revenue. Oh, was it Nibius or CoreWeave they did that
Yeah,
with?
no, Nebius won a huge deal also for Microsoft with
Okay.
it make them also small enterprise, medium enterprise, government, and like the
Yeah.
mega the hyperscalers.
So really, these companies are both serving similar similar companies, but Nibius is more on the small and mid-sized companies as well. So taking that into account from a diversification of customer base, I look at this and I go, Nibius has been on a steady move higher, but I do look at that gap and I am concerned about it. If I look at it from a weekly standpoint, unfortunately, we don't have much for CoreWeave to look from a weekly standpoint, but for Nibius, we can go back to way back. We're at all-time highs at this point here, and I think the environment will warrant a pullback for Nibius. But I think overall, from my perspective, if I was going to invest in either one of these companies, I would invest in both of these companies. One, the footprint that they both cover. One is more the concentrated hyperscaler mega companies. Nibius has got a more of a spread out client base. Um, Nibius has more cash to debt versus CoreWeave. So from that perspective, there's more risk in CoreWeave, in my opinion, in this period of time because of the overall economic environment that we discussed just earlier. But allocating to both of them may be more heavier on the Nibius side versus CoreWeave, just for a risk standpoint, in my opinion. There's more history stock-wise with Nibius versus CoreWeave. That is also something to take into account. So overall, when I look at this, overall the sector of data centers and GPU compute, there is still more ramp up, but we are likely to see something similar to what we saw during the dot-com boom bust, and that is the hype eventually will come down and normalize. And I believe if these two companies can withstand that normalization, these are two companies that could perform very well in the next 36 months or so. So that's my take on these two individual companies at this point. So let's open it up to the floor for discussion. Any ideas, that kind of thing.
I agree with you. After I've done a lot of checks, I think Nebius is like it's a little bit better company than like CoreWeave. They both good, but I would like, if it's okay, I would like about what I understand also from the NVIDIA, the guys that I spoke with them. In the end, it's not matter who is winning, AMD, Broadcom, NVIDIA, or any other. They're all in the end of the game. They all going to Taiwan Semiconductors to produce it, and it's like a very low multiple of price to earning compared to any company. So if you can maybe show maybe a graph or your thoughts about Taiwan Semiconductors, I will appreciate it.
Sure. Pull up. Let's see. Was it TWMC?
TSM.
ESM.
ESM?
Yeah.
Like
Oh,
when
Euro
the risk,
Sun Mining?
TSM.
what I was thinking, like
Okay.
my
TS.
latest thought was if all the CoreWeave Iran Nebius is booming because it's a very high beta, I think Taiwan is very unvulnerable. Like he has like all the clients in the world. Basically, it's a monopoly. Almost no debt, and it's for sure will survive and will succeed. So maybe to take some money from those companies and to do their risk with Taiwan Semiconductor. That's what I'm thinking right now. But
So,
I,
okay, this is interesting because I look at Intel and the relationship that NVIDIA announced this week, the 5 billion they're putting into Intel, and the partnership they're developing. And I look at Intel as the company that in the next possibly 3 years, NVIDIA will buy Intel. and acquire them. And I believe that because I believe the geopolitical risk of Taiwan Semiconductor, the major concentration of everybody manufacturing with Taiwan Semiconductor, and the vulnerability of China, in my opinion, that really creates an enormous vulnerability for NVIDIA. And I think this deal, and if you've read the book, or I'm like 3/4 of the way through The Thinking Machine, which is a book on Jensen Huang, and he even says in the book that Intel, if they could get their strategy and implementation right, they could crush NVIDIA. And I think just that statement sort of resonated with me when I heard, was a couple of days ago, when NVIDIA said they're putting in 5 billion into Intel, and you saw Intel stock jump like 20-30%, some ridiculous amount. To me, that is a strategic move on NVIDIA's side of things, saying we are vulnerable, having everything manufactured in Taiwan, and now also China coming out and saying we don't want you to buy NVIDIA chips anymore. That's another level of vulnerability. In my opinion, I look at it and I'm like, NVIDIA could come in to Intel, help reorganize it, help it basically get more efficient, more effective, and they could start manufacturing with Intel at some point in the next 3 years. And that would then open the door for NVIDIA to come in and say, we're going to take a majority ownership of Intel, and we're going to manufacture here in the United States. The other element is that political side in that relationship that NVIDIA has with the White House. You see more conversations being had between Jensen and Trump. And to me, there's something going on there. And you look at the future mega mergers of the world, that have happened historically, and they start out with some level of a partnership, a first date, and eventually, it's the second date, and then eventually becomes a marriage. And I think we may be seeing that between NVIDIA and Intel, which would hurt
Not
Taiwan's.
to mention the U.S. government owns almost 10% of Intel stock.
Yeah, yeah. I mean, when I look at a chart of this is a weekly chart, and if I put my charts on my system on it, this is a weekly chart, so each candlestick is a week in time. It right now is following my trade trend line, which is the 52 period moving average. In this case would be, or excuse me, the 15 period moving average, which is the 15-week moving average. And as long as it stays above this intermediate trend line, this yellow line here, I'm okay with it. If you've been in it since it broke through the 200, you've done very well. I just don't know if right now is a healthy time, because your RSI right here is up at 78.07. And your MACD is in nosebleeds territory as well. So I think just keep an eye on it. And you look at the volume, it's just slowly declining. And so that tells me less and less buyers versus sellers. So if they're buying 3, they're selling 1. If they're buying 2, they're selling 1, kind of scenario is starting to happen. So I'd be cautious. Not to say Taiwan Semiconductor fundamentally has anything wrong with it, not at all, but it's just, I think it's part of the cycle right now.
So there's a
Nebius
question out
and
there.
Co where they're standing in the RSI and like the over, like, because it looks to me CoreWeave, Nebius, Iron, it's all like, so like it went so high in such a short time. So like,
So that's a daily of the CoreWeave. Its RSI is at 62, so it still has more potential strength. Its MACD is starting to flat out. So, and take into account, these are all rear view looking oscillators. It's not telling the future, but it's giving you an idea of what the future could look like. And if you can look at CoreWeave now, it's sort of just in this resistance level that was created back here in May 27th, 28th, 29th, dripped down a little bit, then broke out on the Tuesday, the 3rd of June. And we're right back at that point again. And so that's something I would take into account as well.
A question about Iran and Palantir, up over 300%. This is Ray. Longs for me for the most part until they aren't. I understand taking profits, DCA. Curious how you would act, not financial advice. All that understood. Just looking for an opinion from having many more years of experience. Thank you. And I thought I was going to get off, not have to answer it because he did to you, and then he put on, Mark, absolutely the same question to you. So I'll go first because
Okay. Here,
I
let me
don't
give you the
invest in
chart.
either of these. No, okay. All right, Mark.
You want me to put it
I
up?
don't. No, I got it. I
right.
don't invest in either of these two right now. So if I was to invest, my long-term holdings are basically Berkshire Hathaway, Bitcoin, MicroStrategy, and some ETFs, and then some long-term treasuries. And then I have an income account that brings in income monthly or weekly. And so very few long-term investments. When I look at Iran, that's quite a run, and you're up 300%. That's a lot. I'm not saying to get in or get out, but never hurts to take a little off the table from my point of view. And then on Palantir also. Palantir, I mean, it just had a hell of a run. Let's go. I mean, I think it was back on the 30. Let's go back 2 years on Palantir. Okay, I mean, if you're back here, I mean, look at this. You're over the 200. Well, pretty much. Let's see if I can get it to move. Well, let's say right about here, you got over the 200. But this is for Paul Tudor Jones people for long-term investing. You're over the 200. You bought it at 21.87. Okay, today you're 182.39. Okay, and you're still over the 200. So the way I look at it, if I were looking to invest in this, I would look long-term along the 200, and you're way above the 200. The 200 is still rolling up. The 50 is still rolling up. The 9 still rolling up. You are hitting some resistance here. You're all-time highs, and you've hit it here, and you've hit it here. So I'm going to be watching on this one from a technical point of view to see if this one comes back down and you end up having a double top here. Okay. And if you have a double top, normally you'll see it fall from about the place where the tops are to right where you have a neckline down here. And it would fall down to almost to 200. I'm just eyeing it. If it did a double top, if it can break through resistance, and it hit past this all-time high, this looks like an all-time high over here of 186.97 and sustain, you've got some more room to run, my opinion. Trent, up to you
now. So Iran is one that I did a comparison a couple weeks ago to Iran. This is Iran from a daily chart, and S.F.Mahaney, symbol CIFR. And conclusion I came to was similar to what is interesting between Nibius and CoreWeave. And these 4 companies have one thing in common, and that is cash on hand. Both of Iran and Cipher Energy or Cipher Mining are started out as Bitcoin mining companies. Iran has began the conversion from Bitcoin mining to data center development and offering up GPU AI cloud computing. These 2 companies are really separated by about 2 years, year to 2 years in evolution. Cipher, this is Iran, and I look at it and I'm like, well, as long as it continues this ride up the 15 period, my trade trend line, period moving average, then we're good. But if I see a crack or a break below, I may want to start taking a little off the top, especially if I bought it back back here or down around $78, or I'm up 300%, maybe I take some cash off the table, but still have exposure to it. But if I break through this intermediate trend line, which is the 62 period moving average that I use, then I know something is changing pretty drastically. Now, in this case, it would be the overall sector is changing. The overall economy has changed greatly. It doesn't mean that Iran is a bad company. It just means money flow would not be flowing into this company or into, in particular, its sector, that being data center or GPU, offering up GPU power services. That would tell me that then that demand is weakening. And we would see that across Iran, we'd see that CoreWeave, Nibius, but also, I'll pull up S.F.Mahaney here. We would see it also with S.F.Mahaney. This looks almost like Iran as well, but we're starting to see this 1, 2, 3 days of sort of topping here. And we talked about this on the Morning Edge over the last week or so. We're starting to see the MACD roll over a little bit on the RSI. But I look at this, and the two differences between why I like S.F.Mahaney versus Iran at this point, from a fundamental standpoint, is S.F.Mahaney continues to hold its Bitcoin. So it's they hold it in their treasury. It's an asset that they can borrow against. And if Bitcoin goes up, their overall value, underlying value, goes up as well. Whereas Iran sells off all their Bitcoin when they mine it, which tells me they don't have that asset that they could rely on and collateralize in the future. And that, to me, is sort of like, okay, that's sort of troubling in this economic environment. So I look at this. Plus, if I look at Cipher Energy, I got more room to go if I'm comparing it to Iran. So if I'm holding Iran, I would consider looking at dispersing a little bit of those assets towards S.F.Mahaney and buying on the dips and positioning, because I think S.F.Mahaney will be another Iran event. And you'll see it go from, I think when I started talking about it, was in the $7 range. Kerry's crypto mining chart on his tell sheet it showed up as well on there. And that was down around that 6-7 range. So it's basically doubled on price already. But I look at these two companies the same way I would sort of look at Nibius and CoreWeave. Nibius I had overweight versus CoreWeave because of debt to cash ratio and risk of concentration into a handful of companies when it comes to my customers. S.F.Mahaney has more capital that they can use or sell to pay off to keep the company running, versus Iran doesn't have that kind of cash level. Plus, Iran's had a major move in the last couple of months.
Maybe,
so, yeah,
maybe another perspective. To me, okay, in my opinion, it looks like I'm still holding Iran, which is very hard mentality. Okay, like because like it's very hard to hold after like all. But when I look of like what the CEO have done, he was working in Macquarie, like 5 billion or 6 billion alternative manager of infrastructure. He moved from there. In 3 years, he built one of the biggest Bitcoin mining in the lowest like costs. He saw first like the opportunity of data centers, and now just to get a perspective, Iran is 3 giga. Just to understand, Stargate, which they say it's, I don't know, $500 billion, it's only 5 giga. So technically, they have like the biggest data center in the world, like that is now big like 2 giga. So when they are selling their Bitcoin, it looks to me like the story of like really building this huge data center is more real, because like if you want to build a data center, you have to be with money. So the story make more sense than like, okay, I want to build a data center, but I holding my Bitcoin. It's not working together. It's like very intensive from capital, like to build those data centers.
Sure, absolutely. Yeah, and that's a very good point. You have to spend money to make money, right? I think that's the
Yeah.
conversation my wife and I have every once in a while. But I guess when I match it up with where we are in the economy and where we are with what we talked about earlier on the call, I wonder about vulnerability. And having been through the .com, through the housing, um, debt can kill you. And and if you don't have cash, that can hurt you. Now, go back 3 years, not so much of a worry. That's a major expansion period of time. Deploy capital, build out facilities, this, that, and the other. But now we're getting to a point where there's other variables that are fracturing the credit system that could cause concern. And so I guess when I look at these companies, I look at Iran and I'm like, as long as they can weather a storm, will it be $130 stock in the future? I wouldn't doubt it. We'll have more demand going forward for GPU compute. It's
But
gonna happen.
Cypher is
It's
making
happening.
money. It looks like Iran making money, but Cypher don't. No, like when I look on the financial.
I think you're right. Yeah, if I remember correctly. But I guess I look at it from the other perspective, and Kerry pointed this out a couple weeks ago. When you're looking at these mining companies, you can't apply the you have to apply a different fundamental analysis approach compared to a Apple or a Nvidia or somebody like that because of um how they keep coin or keep their Bitcoin, that kind of thing, and that has not been used in a fundamental analysis in the past. And so I take that into account, but I guess I look at Cypher and I go, I think I see more upside potential in the next, you quarter, actually the next 6 months than I do as much as in Iran. So, but I still think they're both solid, good companies to consider holding. Not advice or recommendation. All right, what else? What else we got here?
Those are easy on us today.
How about 2-3 years? Which one of those are more reliable to keep?
2-3 years from now. I have a problem with trying to figure out that far out in time. And the reason is because 3 years ago, we never heard about AI. All of a sudden now AI is everything. And I guess when I look at all this, I go, I think this is moving so fast that you have to almost look at it. I have trouble looking beyond 12 months. These companies could easily, all four could be doing wonderfully. And I don't doubt they will. I believe they all have their place in the their footprint. But I also look at it and I go, I mean, 3 years ago, did you know about OpenAI? No. I mean, they
But
launched
that is
November
not a
of
good logic,
22.
really, because obviously all the time those things happen.
Totally.
But if you go and look, if Kerry's tell sheet having all three of them and giving them facts and figures, but still, a lot of intuitive knowledge as Omri is talking or others are talking involved. So I personally get into these things not for 2-3 months. I'm hoping at least a year, as you are saying, or hopefully more than that. I don't want to all the time start changing, selling this, buying that.
Sure.
So
I'm
when
with you.
I'm getting into it, I am hoping that would be a good thing for 2-3 years. And that's one of the reasons my being with you all, incidentally. I don't know how many of your clients here in this big list are like me versus day to day or weekly or monthly. So I always listening to see eventually if I get from you something which will guide me on that. In fact, I bought all two of them. I wanted to buy Corby, but unfortunately I got to it after the Microsoft deal. So I thought it's too expensive. So I'm waiting to see if it comes down. For me, all three of them would be a good 2-3 years things to hold. That doesn't mean that I'm never gonna sell before 2-3 years, but when I'm buying, I'm hoping that is that sort of things. It's not for 6 months, it's not for 2 months or 3 months. So
Art, I'm more in the camp of you. My tell sheet 12 portfolio is based on that, identifying, taking Kerry's list, his tell and watch list, identifying those companies that have strength based on some parameters that I laid out, and we've made one change in it, and it's up a ridiculous amount since I put it. It's a paper trade portfolio. It's 12 companies, but it was based on the approach that you're taking. I don't want to make a change in that portfolio because one, it's pain in the butt, but two, if they're good companies and they fit in to a category, and they rule their category, they will continue to go up. But I do know that at some point there will be a pullback, and I think that's where you go, okay, I have parameters that says, if I'm up 300% in the stock and it breaks through my trade trend line, I start to consider reducing my position a little bit. If it breaks through my intermediate trend line, I reduce it. So I keep my capital. The worst feeling is making a ton of money and then losing it all. And I think we all probably have done some version of that. It just sticks with you. And that's part of the risk management element. But I'm with you, Art. I want to buy a company, and I want to own it. I want to own it for a long time.
I was one of those that in 2007-8 deal, I lost a lot. So I know exactly what you mean. And
Yeah.
because of that, today I listened 2 videos in the internet, or really, what's that? In the videos that they come, both of them about predicting that 2006 might be another major crash, and they were looking at to see what can be done to prevent ourselves. And I know you had a very good video yourself on these things, and you said that you're going to talk about that today. So if any of you interested, those 2 videos I thought were very interesting, both of them. One of them identified 4 major crash in the history and tried to learn lessons for us from that. This is an Asian-looking lady that is American, though no accent, as much as I can say. Is today YouTube. The other one is more of a Bitcoin type or crypto guy, but he talked about 3, I believe, major forces. One being cycles that I think our friend was talking today in our discussion, and the other one was the what was it? I think the government change or something like that. So all 3 of them were going about sometimes mid next year or something. So I am just mentioning that you all also be a bit conscious of that. This growth we are having is just too much, and a good deal of chance that may come down.
Well, that's why I think that's why I kind of started off going over my thoughts on what I've seen, and I didn't get into all the details, but I mean, I looked at jobs being revised down. I looked at inflation still going up. I looked at companies like Tricolor coming down, you know, and starting these bankruptcies that could roll into banks. We don't know yet what's happening to that. Consumer sentiment's down the second month in a row. Market valuations, I talked a little bit about that. Let me get into that a little bit. We're really trading at high market valuations right now. Two of the indices people watch are the trailing 12 months PE ratio. Okay, and currently we're at 30.72 on the S&P, and long-term average is 16.5, so about double. Schiller PE CAPE ratio is currently at 39.78, and that's normally 17.6 long-term. So the current valuation on the Schiller is 80 times higher than the long-term average. And Schiller has only surpassed the current level a few times in modern history. One was the dot-com bubble at 44.2, and also the Roaring 20s at
So I think in
33.4.
the 20s it was lower. And today it's higher.
Today is higher, right?
I
Housing-
think
housing-
it's,
Housing starts are down 8.5% month over month, the fourth largest reading since 2020, which is the great financial crisis. Building permits are down 3.7%. Americans living paycheck to paycheck at 67%, up from 63%. Delinquency rates, auto loans, credit cards up by 60% since 2023. Business bankruptcies, we looked at those. Margin debt, all-time high, over $1 trillion. Again, we talked about a market dropping 15-20% could cause a kind of a snow slide down the mountain. Last time it was this high, margin debt, dot-com bubble in 2000, in the great financial crisis.
even
So
higher
that's why-
than the 2021. It's the Schiller P, it's higher than in 2021. even.
Yep, yep.
I had a conversation with a buddy of mine. He lives in Cincinnati, Ohio, and we were talking, and we've known each other since high school, and his daughter's going to graduate from high school in May, and he told me he's going to sell his house. They're selling their house in Cincinnati, and they're moving out of Ohio. And I was like, "Why are you doing that?" And he says, "Because I'm going to pay $20,000 in property taxes on my $700,000 home." He said that plus the insurance, plus everything else. He says, "Trent, it's how do you get ahead?" And I'm like, right. When you get to a point where you're middle America and you go to the grocery store and you have a memory of what you paid for your groceries 6 months ago and it's more, you know that's straining not just you, but it's straining everybody economically below you. And I think that those are little indicators. You know, Peter Lynch is famous for investing in companies that he identified when he went to the mall on Saturdays with his kids. He would sit in the mall and he would watch where all the kids went to shop. And then he would go on Monday morning and start researching those companies. And a lot of those companies he bought. He watched human behavior. He's no longer a fund manager, but you look at human behavior, you look at the world we live in. We credit card, I don't know how many credit card offers and private lending offers I get a day. It's ridiculous. And people are buying into this stuff at 30% interest rates because they're tapped out. Life has gotten too expensive. And eventually that peak, that vertical move eventually tires and something breaks. What's going to break? I don't know. I have no idea. But I think this is where you start to pay attention. You don't get cynical about it. You don't get upset about it. You pay attention. You watch what's happening. Next month, we'll spend the month in Round Top, Texas again with my wife. She's doing another 2-week art show. And she started doing it in October of last year. She did it in March, April of this year, and this will be our third time. And I can tell the buying behavior of the middle America has gone from spending, say, $1,000 with ginger to $500 to less than $500. And I anticipate this show, and she and I talk about it all the time, price your stuff below 300 and sell on volume, because that's what the consumer can afford.
Yeah.
And I've been right twice, 2 times, and I suspect I'll be right again. But I think those are the kind of things that when you go to the store, if you do your grocery shopping or you go out and shop, I had to take the truck in to get new brakes on it. I don't understand why at 40,000 miles I'm putting new brakes on a brand new truck. But anyways, they're offering to swap out my truck for a new truck, no down payment, no nothing. And I'm like, they're desperate. They're desperate to sell trucks. They're desperate to sell cars. And when you start to notice these patterns, this is how you can become a better investor. And when you start to see the volume of that more and more, and don't watch CNBC, don't watch the news, look at how America, Europe, Asia is acting, and you can get a better sense of where things are heading.
Yeah. Uh, I have a question
Yes.
also about, in addition to Kerry's tell sheet investments, I also like, I think, putting fair amount of funds in Berkshire Hathaway B. Like I think Mark likes Berkshire Hathaway B also. At least I think it's less volatile than the other, I think, the Mac 7 or some of the other technology related companies. Do you think that that would work? I mean, meaning that is it that's a best option? I mean, to put certain portion of my investment into Berk B.
So, Mark, you're on mute.
Yeah.
I personally think the market is looking for value. They're looking for fair valued price companies. And Berkshire B has, it went down after Warren announced he would be stepping down as CEO back in
Yeah.
March. I think in March or so. Was it
It was
March?
May. It's May.
May. And
It
then
was at that
all
meeting.
of a sudden,
Yeah.
Berkshire started to make a move back in here in August.
Well,
Yeah.
we kind of got down to the 200, and you can see here went sideways. Then we got below the 200. This is kind of your investment line. If you're a Paul Tudor Jones guy, try to get back up into it in July, couldn't. Then we got back up in the end of August, and we actually on morning we're doing. Not only did a swing trade on it, but we actually did an investment on it where it hit the 200 here. This line is our cost basis, and we've been watching it. It's come down and it's bounced off the 200 again. You can see today it's back up above the 9. So again, we're testing out Paul Tudor Jones theory here. Doesn't mean it can't go below there, but it's a good level of support, and then it becomes a good level of resistance if it gets below. So when you look at Berkshire, you're looking at a company that has $384 billion in cash. Okay, and I've been in this since Berkshire B came out, long time. I don't particularly like them having it in cash. I understand why, but they're losing monetary inflation.
Yeah.
It's taking away about 10%. They're getting 4% on their short-term treasuries. And now with the rate cut coming down short-term, that's going to bring it down probably the 3%. So still it's $384 billion. They're going to get monthly checks from the government on that, but it's not going to be as high. So I think you're seeing some of that, on this chart heading back down a little bit. The good side is he's got all that money. And if the market does head down, he's got a lot of cash to go buy, and that's what he's known for. And the companies he has railroad. he has communication companies, he has home builders, he has RV builders, he has financial service companies, he has oil companies. I mean, he owns them outright and then he invests in them. He owns Apple, okay, even though he's been divesting. He just bought some home builders, Lennar and
Yeah.
DHI, Horton. So he's very diversified. He's got a good record, and over time since 1962, he averages about 19% a year. Not every year, but the average return. So that's what you got to look back on when you're going to invest. And then the key is at what price am I going to invest at? You know, and right
Yeah.
now we kind of got a class going right now on where we might want to invest. You know,
I want to bring to your
Yeah.
attention that he is, or the BRKB is 50% cash, exactly.
yeah,
That's a lot.
50% cash. What does it
that's a
mean?
lot.
That
Mark,
means I think that means he knows something's up.
Knew something.
Well, if you look, he calls it the Buffett indicator. I think it goes with GDP, and I
Yeah.
can't remember, but it's almost twice above his level. And so if he's looking at that, it's flashing red signals to him.
Yeah, but it doesn't always go with B share price. It doesn't always go along with the S&P 500 and Dow.
No, yeah, you're right. And
Is
More
like
of a
Trent said,
value.
it's been seen value as a value company, basically.
I see.
But when
I
you
mean,
buy
think
it,
about it.
it's highly diversified.
Mhm.
So I mean, if one of his companies goes down, it's not going to take down the whole ship.
Yeah,
So
right.
Mark, I feel that today you are very cautious because we are like on the, let's say, the eye level. Maybe you can do in a methodology way all the signs of like you say cheater PE, and then like even together all the signs why the markets might be a little bit too high, and like just it to be like in a methodology way that's like you
That's what
I
understand
think
what
that's what I was
as
trying to
simple.
do. But I just went through my huge list of things that really
I
bother
think
me right now.
I think the simple approach is look at a chart of the S&P 500 and look at, say, a 10-year chart of it and look at the behavior that it's doing in the last, I don't know, 3 months. And ask yourself, is this the behavior of excitement, new money coming into the market, being deployed towards risk? Or is it a market of concern? And if you look at just simple, I can't, I mean, it's been the whole summer you've been talking about, well, not the whole summer. It's been really the month of July, August, now on the morning edge. The S&P is always up against the ceiling. And it's boom, 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 boom. Why? Why? Why is it not going higher?
Oh, it is.
And I
It's at
think,
all-time highs.
right.
Slowly,
Well, that's
slowly.
true.
Yeah. But
I don't
it's
know.
not taking off like it used to.
Yes, that is a good point. I don't know. Like I said, I think it'll go to 7,000 by year's end. The S&P. It's just after that is my concern. Slowly happens, and then all of a sudden.
I can't make predictions because I
because the multiple are high by all measures, like, and the thing that we're growing a lot, like core we've never like also like the thing with the good growth, like we're booming, and like all, so it looks like I don't want to say nothing left, but like I agree with what you are saying, but like okay, so let's go the other round maybe. Like what can like take the market up strongly, like to see the like
I think
Even
that's
time.
Omar. I think
Yes,
that's
in your
why I
opinion,
use
or-
technical. That's why I use technical indicators to help me. They're not 100% for sure because they're backward-looking indicators and oscillators and moving averages. But it gives me a fighting chance because I know what professionals are using because I've seen it when I was there. 200 for sure, 50 for sure, 20 for sure, and whatever their short-term indicator may be. And then they throw it into a nice computer program and it trades on their own. And we sit here and we look at charts, you know. But there's, you know, so that gives me a little bit of, of hope of where to get in and where to get out. But again, on the other side, I look at what's happening and I go back in history and what happened before the great financial crisis to all these indicators, you know, economic indicators. What happened before the dot-com crash. And I lived through both of those. My first crash was the crash of 87, where we dropped down 25% one day. And I think
Yeah.
it was only, I think we were only at 500 in the Dow or something, dropped down 25%. But you know, now we're in the thousands or whatever. But it was a heck of a day because you couldn't go. We didn't have online trading. You had mutual funds and stuff, you know, and if you had an IRA, and everything just dropped and you couldn't get out. And now we have more of a fighting chance because at least we have an opportunity to get out if we want. But you know, I'm very cautious, Omar, because I've been through this before, and I've seen a lot of people. You know, and the market is a great place to make money and to build wealth. It's also a great place to lose all your money and to go into retirement working at Walmart, or as Trent says, you know, the next question you ask is, you don't want fries with that burger, and that's what I don't want for anybody here. I don't want it for me. I don't want it for anybody. Not that I'm chisking on the people who do that. That's the job we need. So I just don't want to do it in
Yeah.
retirement.
Yeah, yeah.
One other thing I track, systematic funds. These are like insurance companies, hedge funds that run quant models, algorithm driven model companies. And this is a big part of what trades on a day-to-day basis throughout the world. You saw this sort of accelerate when the internet became, you know, when we knocked down the Berlin Wall and we connected the world through fiber optic. All of a sudden we became very connected as a world, and we saw the evolution, excuse me, of technology, and trading and systematic funds have become very big. And right now my tracker says systematic funds are upwards of 80 to 85% allocated since April. So they've deployed 80 to 85% of their capital. Now, remember, a lot of these funds have to keep 10% for redemptions, that kind of thing. So if you chop that off, they're pretty much fully allocated. They've made a lot of money. The ones like hedge funds that run these models, like Citadel, I think runs those models. They're leveraging that money. So they've made a lot of money since April.
Citadel, by the way,
So
is one of the biggest like names that owns Iran.
is who?
Iran, Citadel owns them, like some of the stocks, like a pretty big chunk.
Yeah. So when these companies have made a ton of money and they've deployed the majority of their capital, they redistribute that. They take profits and they go look for value. And I think that's
Yeah.
why that's partially what you're seeing happening now with, you know, yeah, we're all-time highs, but they're not like spiking. But I would not be surprised if you see a pullback next week. Today was September option expiration. This is a triple witching day. Happens in March, June, September, and December. And that's when future contracts, stock index funds, and regular stock funds or options expire on the same day. And that's a pretty big day. You go into next week, and that's when a volatility can open up. And I wouldn't be surprised if next week we see volatility in the market, which can be good. It can also be bad. We only relate volatility to negative times, but when volatility does move in a positive way, that's when in short-term traders, swing traders really make a lot of money. But for the average long-term intermediate investor, steady volatility on a low end is what you really want, and that's what drives markets higher. And so I think we're entering a end of the week, end of the month next week, and I think we'll see some volatility in the marketplace. But we'll get into October, and I think you'll start to see the reorganization of these systematic algorithm-driven funds will have reorganized through September, October, partial October, and we'll see a move higher going into the end of the year. And that's when they get all of the retail investors sucked into it, thinking it's all wonderful again. But remember, these guys are all shooting for their bonuses. It's the end of the year, and it's bonus season. So,
And they get it from taking it from retail. That's for sure.
Yeah. So I don't know. I mean, I think there's money to be made in this market still, and I think there's opportunities, there's value out there. You just got to dig a little deeper and look for it, and then have a good risk management process behind it.
Have a good trading and investment plan like we try to have on everything we do.
Yeah. So, all right. Well, anybody else got anything they want to hit upon?
Yes, Trent, I'm sorry to bring up some
Yes, sir.
housekeeping, but my
Yes.
platinum membership, I've changed over from Patreon to Best of Us Investors, and so I've paid double this month. So you may have to
Okay.
reimburse me.
Thanks,
Yeah,
Patrick. Appreciate it.
Because you did say 2 weeks ago that all patrons should migrate to Best of Us Investors, which I've done.
Yes.
So that's bonus.
So you've got a bonus this month. So you could buy yourself a family. You could go to take the family out on my expense.
No, I can't, because it's too much
Get a
now.
48 pack.
Did you pay in pounds or dollars, Patrick?
Dollars.
Okay.
Paid you $51. So I'm sure that would buy a couple of burgers anyway.
That's
Couple
true.
pints
Yeah,
for
I can
sure.
get that. All right, so I'm going to put my if you want to text me, I'm putting my number there, or you can.
I'm unable to text you from. I'm in the UK. I'm not able to do that.
Can you shoot me an email?
Yeah, but you better read it, okay?
Yeah, you know what? I've made that like I've started going to the support at bestofusinvestors.com every day.
All
and
right.
I'm being diligent about it. I'm doing my best. So yes, I will see your email. And for anybody who hasn't upgraded to platinum and wants to stick with the program, why am I doing that? You're having trouble upgrading, feel free to email me or text me, give me authorization, and I upgrade you on my side of things.
Just recap. What is your email again, Trent?
I'm putting it in here. Support at Best of US in. Just make sure I got it right. Okay, I put it in the chat. I put my phone number. Text me if you will, if you have questions, if you like to use text, and then or you can email me as well. And any questions, comments, that kind of thing. I've had people text me and say, "What do you think of this company or that?" And typically, I'll put it in the Discord.
Yeah, we have a Discord where we all have an office. You guys can also get a hold of us there, and it'd be more public for everybody if you're talking about a stock.
And if you haven't, you don't have access to the Discord, let me know and I'll get you access to it. I consolidated it this week. We're going to add a couple things in the near future to it. We're simplifying it. Some people have said they don't have access to Kerry's trades. There is a new tab in there called Problems Fixes, and I have found the majority of the reason most people don't have access to it is because you haven't selected it as a channel to see. And so it shows you how to go about doing that. Anko, yeah, I know. The yearly subscription approach. I'm having trouble technology-wise, making sure that gets done right. So I apologize, but I hope to have it up this next week or so. Yes, Michael.
Yeah, I saw a chat from you on it has a logo of the Edge. And and you mentioned in there that, if you get offers from other people, it's a scam.
Yeah.
And I'm looking at 3 Trents, and they're all asking me to do stuff.
Yeah, I'm not asking
Is
you to
there
do
any way to
anything.
block all these people?
So this week I've spent about 5 hours trying to figure out. I put a bot on there that filters through new people. Um, I'm seeing less responses like what you're saying, that people are getting these DMs. I've gone through and looked for these copycats or these imposters, and they're not showing up in the members thing. So I don't know how they're doing it. It's
You're
a
tricky,
constant work in
slimy,
progress. What's that?
tricky, slimy sons of a gun.
They really,
No kidding.
I have a more little descriptive wording for it, but yes. But yes, I would agree with that. But yeah, so
Yeah.
just so everybody on this call knows, Kerry, Mark, or myself do not DM you and talk to you about going to another website and joining this program or this, that, and the other. We do not do that. I rarely DM. I actually DM'd a gentleman here because being overseas. But I don't. And if you know me well enough, you know how I talk or how I write. I'm not that professional as that well. So just always question if somebody's asking you for money or to join something else other than what we're doing here. Question it, please.
Will
Trent,
do.
could you or Kerry contact Discord to hold these guys or throw them out of the Discord that they won't do this?
So we've reached out to them on other issues, and we end up in in the queue. Yes, we'll address that. Okay. Well, you haven't. I don't know what it is, but
I think they're busy with the FBI right now.
are they really?
Yeah,
Oh, I didn't know that.
yeah.
What's that all about?
The Charlie Kirk shooting and how that shooter used Discord or was on Discord.
Oh, oh, wow. I didn't know that.
Yeah.
That's really sad.
So they're probably pretty busy. They're probably pretty busy with that.
Yeah. So with this October 1st switch over, I'm hoping that we clear out a lot of this imposters kind of thing. So hopefully that'll change things in the future. But please don't. I've had, unfortunately, a old client of mine. I don't use WhatsApp either, just to let you know. He got scammed by somebody on WhatsApp, and they basically, the person impersonated me as a crypto trader. And so just be careful of that kind of stuff.
Did you get
Linda's,
Ernesto's email? Did you get Ernesto's email there?
yeah, I got it. And
Okay,
yes,
good. What's happening October 1st? Linda wants to know.
so this is Kerry announced in August that we were going down to one platform, and that is the Platinum platform. We are capping this at 1,000 subscribers, and we're fastly approaching that number now. So if you want to be on the Best of US and part of the 1,000 people on the bus, you need to upgrade to the platinum level by October 1st. The midnight of October. Yeah,
September.
I'll give you the day of October 1st, but at midnight, I'm going to switch it over, and everybody who's in starter plan gold, that kind of thing, we're canceling. And so we're consolidating it. There's a lot of reasons why, but a lot of it is we want to really focus and concentrate on the group that we have and be able to do some upgrades and that kind of thing. So we're excited about it. We're seeing a great response, and I think it's going to be real beneficial for everybody.
Yeah. So what changes we would see from October 1st when you change from when you change to the platinum, everybody?
I'm sorry, repeat that.
No, what are the changes we would see from October 1st?
That is a discussion once Kerry gets back. We're gonna highlight. You'll have access to everything that we do in the future, any new services. My goal is to one, make the Discord more usable. Two, I want to clean up the website, make it more usable, which means some upgrades there. And then really make available us more. I've had more questions about the Tell Sheet 12 recently and what it is and how it works. And I've thought about doing a weekly or bi-weekly call to talk about it, the companies. Really more interaction with you all. And really from there, I had a one-on-one Zoom call with one of our subscribers the other day. Went for a half an hour or so, and it was it was great. Number one, um, and we both got a lot out of it, and I think that's more and more I want to see more of that kind of value added to the tribe. I did this with my financial advisory practice back in 2006, where we had 1,000 clients and we brought it down to 200. And those 200 got better service from us. We were able to scale up our service level. We were able to add more value, and we also sidestepped the great financial crisis as well, which was nice. So it's a matter of fine tuning everything. And when you get spread out in a business, you get weak. And that's my concern about going forward, especially in this environment. So that kind of thing. Yeah. So yeah, but I'm excited about the move, the change. My vision for best of US investors, and I think it goes along with Mark and Kerry, is teach you all how to look at markets, how to digest the information, and then how to create a better process so you can turn your dreams and goals into reality. It's the one thing I've learned is you don't take any of it with you. So the only thing I know that I think about, I think about my sister a lot, and I'm like, she went upstairs, and the only thing she took with her was her memories. She left a lot of crap behind for my brother-in-law to deal with, but she in my opinion, you take memories with you. And I think that's what this is all about, is creating memories, being able to do fun things. And I recently had a conversation with somebody who went on a cruise, and she said it was because she's making money on what we're teaching. And to me, that makes me really happy and excited. Makes me get up at 4:30 in the morning every morning.
Yeah.
Thank you.
Couple more questions on there. So
Okay.
I'm new to this. How does the Discord access work, and is it included with Platinum membership? It is included. And then you got a question about the morning show, about when it gets posted, the Morning Edge.
Hold on. Sorry. Where is it?
It's right at the end. Linda has a question.
Why does it take
AM
so
has a
long to
question.
post your daily morning videos? Recently, it's because so the question is, why does it take so much time to post the daily morning videos? Because in the last probably 2 weeks, I've been pulled in a couple of different directions in the morning, so it's delayed my posting of them, editing them and posting the morning edge. I'll work my best to try to get them up before. We typically finish up around 8:30 Central, 8:45. Takes about 15 minutes for it to render and download, and then I gotta format it and the whole bit. So if you give me to about 9:45, 10 o'clock, I'll try to have it up by then.
Central
So
time.
Central time, yes.
Sorry, one question to you, Trent. If I
Sure.
send it to support at Best of Us Investors, will you respond?
Yes, sir.
Okay, thank you. Thank you.
I promise.
Thank you.
I had a talk with myself about email. I'm like, you just gotta quit avoiding this. But yes, I will. I will. So
And
I
then
may not
the
respond
question,
tonight, but I'm supposed to go to dinner tonight with the fam. So but I will definitely respond in the morning.
and then Discord access, it's included with the platinum membership.
Yep.
I don't know what the specific Discord access would be. Is that with your
Well,
when you
now it's
sign in?
say that again.
How does he get Discord access or she? AM?
Here I'll put send me if you can send me an email at support at Best of US Investors or text me. The information's there in the chat. I'll send you a link to the Discord. And then
Okay,
it will
good.
ask you why you're investing, and then also it'll ask for your email so I can verify you. So if you'll fill that out, then I'll get that and I'll approve it and we'll get you
Okay.
set up.
They said, sounds good, thank you. Perfect.
Awesome.
All right, I'm ready for a pint or two.
Okay.
It's been a long
I think
week.
Michael has a question there.
Oh, Michael does. Oh, where's
Yeah,
Michael? All right, go, Michael.
you're on the meeting and you're not chatting now while you're in the meeting, right?
What's
We're
that?
chatting
Trent?
now over the chat.
You're
On the
not
chat
chatting
we are.
right now.
No.
We are on the
Yeah,
On the Discord?
no.
yeah. I got according to this, your imposter keeps inviting me back. So I just he removed from DM. And I
Can you
told him
take
I'm on a Zoom call with Trent right now. You're not him. Knock it off. And he came back and said, "Thank you so much."
At least it's a polite bot.
Well, first of all,
Yeah, yeah. It's very
at
polite.
least it's okay.
And well, I
Jay,
wasted
thank
your
you
time, but
for
I
the suggestion.
didn't.
I'll check that out.
Can a newbie join the morning call? Have I never done any swing trading? I've always been a buy and
No,
hold and hope.
Yeah, absolutely. You can. We don't just talk swing trading. We talk investments and what's happening in the market too, kind of like this. But we do look a lot more charts.
Yeah.
Okay.
Yeah. We also,
Thanks a
I
lot.
mean, just give you an example. We talked about Robert Redford and his passing this week and the movies he did. And that was
Yeah.
at the end of the
Oh,
call.
that's a great way to start the day.
Yeah,
Well, it was at the end of the call. So,
it was at the end. Yeah.
yeah. But Mark goes over the charts, some news as well, and then I go over more market structure stuff, what's happening in the options market, derivatives market, and then we open it up to y'all's questions. And a lot of times the majority of the call is about what's on your all's minds. We talk about everything really.
We had
So
discussion, pretty long discussion about Intel and NVIDIA and the U.S. government and what we thought there. And we had, we get into different discussions, and if it goes that direction, that's the way we go. And it's
yeah,
very open.
yeah.
Yeah, I
Exactly.
went heavier on those two. I sold half my iron and went through. I divided that into NVIDIA and Intel because I really think there's going to be something happening. I'm not sure what. So I'm watching it on a daily basis.
Yeah. I would encourage y'all, if you I use audiobooks, but the Thinking Machine, which is about Jensen Yang and NVIDIA, that company's been on the brink of bankruptcy so many times, it's crazy. But how they run it in their innovation, when I saw that news about investing in Intel, I was like, whoa, this could be pretty. This is like a Michael Burry moment back in 04, 05, when he identified the crap that was in the mortgage-backed security world and profited from. He's the guy who sort of triggered that whole thing. So I like to look at those kind of things. But yeah, we get into those discussions as well. So please join us. We'd love to have you.
Yep, more the merrier.
I will be there.
All right.
All right. All right. Well, let's wrap it up there. And I will check my email, Patrick, if you're still on. And have a great weekend. Enjoy your family and friends and blah blah blah. All right, Mark. Got
All
anything?
right, guys. Nope.
All right. Y'all take care. Kerry will be back next week. All right. Live loud.
All right,
See
see
you.
you guys.
Thank you.
See you.
Thank
Bye.
you.